Imagine this. You're scrolling through social media and you see a friend post a screenshot of their investment portfolio. It's up 30%. Then you see another post about a new crypto coin that's going to the moon. Suddenly, your regular savings account feels incredibly boring. You start thinking, why am I letting my money sit there earning almost zero interest when I could be making millions? This is the exact moment many people make a mistake that leads to financial disaster, or what we often call getting bonkos. The debate between building an emergency fund and starting an investment is one of the most common dilemmas in personal finance. Everyone wants the shortcut to wealth, but the truth is that the order in which you do these two things determines whether you are building a skyscraper on a solid foundation or a house of cards on a windy day. So which one should come first? Let's look at the investment first scenario. You have 5 million rupiah. You decide to put it all into a high-risk, high-return stock. 2 weeks later, the market crashes, and your 5 million is now worth 3 million. Normally, you just wait for the market to recover. But then life happens. Your phone breaks, or you get a sudden medical bill. You have no cash. Your only choice is to sell your investment at a loss. You just turned a temporary market dip into a permanent financial loss. This is the definition of bonkos. You didn't just lose money, you lost the ability to let that money grow in the future. Now let's look at the emergency fund first scenario. You take that same 5 million and put it into a separate liquid bank account. It doesn't grow much, but it's safe. When the market crashes, you don't panic. When your phone breaks, you use your emergency fund to fix it. Your investment strategy, whenever you start it, remains untouched. You've created a psychological margin of safety. Because you aren't worried about next month's rent, you can afford to be patient with your investments. Patience is the greatest superpower an investor can have. So how do you actually do this without feeling like you're missing out? The rule of thumb for an emergency fund is 3 to 6 months of your living expenses. If you spend 5 million a month, you need 15 to 30 million in your safety bucket. It sounds like a lot, and it might take months to build. But here is a secret strategy. You don't have to choose one or the other exclusively. You can use the 80-20 rule. Focus 80% of your extra cash on building that emergency fund until you have at least 1 month of expenses saved up. This is your starter emergency fund. Once you have that 1 month cushion, you can start putting 20% into low-risk investments, while the other 80% continues to build your full 6-month fund. Think of your emergency fund as your financial shield, and your investment as your financial sword. If you go into battle with only a sword and no shield, one lucky hit from your opponent takes you out of the game. But if you have a strong shield, you can stay in the fight long enough to find the right moment to strike.
Investing is a game of endurance.
The market is designed to reward those who can stay invested for 10, 20, or 30 years. But you can't stay in the game if you're constantly forced to withdraw your money to pay for life surprises. An emergency fund isn't just dead money sitting in a bank. It is the insurance policy that allows your investments to actually stay invested. The bottom line is simple. Don't let FOMO, the fear of missing out, drive your financial decisions. The goal isn't just to make money, it's to keep it. Build your foundation, secure your safety net, and then, and only then, go all in on your investments. That is how you avoid going bonkos, and how you actually build wealth that lasts. Sleep better tonight by knowing that no matter what the market does tomorrow, you are covered. That peace of mind is the best return on investment you will ever get.